You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com and co-hosts, Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
All right, everybody, that rockin' tune means it's time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as from, of course, this here Options Insider Radio Network, back from my week-long sojourn down at the big options industry conference in scenic and sunny Miami. It's rough duty, but someone has to do it. We'll get into some of the interesting developments and findings from that conference in a bit. Of course, if you're interested in all that fun stuff, we put together a veritable plethora, a ton of content for you from the conference. Of course, we have all of the panels coming out starting any minute now. We're going to really break down all of the panels. That means everything, every single session down there at the conference. If you guys went down there and maybe you couldn't make it to Miami, maybe you missed something, we've got it for you. So stay tuned, of course, to our network feed, of course, the website, and indeed, of course, our special events feed on the network as well. If you just want the conference stuff, just subscribe to that special events feed. You can grab it there. You get all the panels, all the updates, all that cool stuff, as well as, of course, we did a great number of interviews down there with a variety of different people from the world of options and derivatives. So stay tuned for that. Pick their brains on a lot of interesting topics that are probably top of mind to you guys listening to the program as well. So stay tuned for all of that. It should be coming any minute now. We're cranking away. We got a ton of content, ton of files to process and edit, but the first one should be hitting the network very soon, maybe even as you listen to this. So stay tuned for that. And I am joined on the old program, as always, by my usual compatriots, my partners in crime, starting off with the man beaming in from the area of the country, only slightly less scenic and sunny than Miami. Of course, it's lovely and balmy St. Charles, Illinois, as we are joined by Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome back to the old Option Block program, sir.
Always a pleasure to be here, and good to have you back, Mark. Hope you enjoyed Miami. We missed you.
I did. I did something down there that is very rare. I don't really do up here a lot, which is I talked on the radio a ton. So I don't really do that up here, as you might imagine. I don't really spend a lot of time on the radio. So I'm surprised I have any voice left. I guess I've been doing this for a while now. I can go through pretty much a full week of dozens upon dozens of hours of conversation, and it doesn't really leave me any the worse for wear. So maybe ask me next weekend. If I collapse in a weeping heap, we'll see.
You are the man.
I guess a few years of doing this will train you. And we are also joined by the Greasy Meatball himself, beaming in from parts unknown. I guess we'll find out, maybe the world HQ of Option Pit there in Riverside, maybe perhaps somewhere downtown, maybe from a train or plane or automobile near you. We won't know until we beam him on. Mr. Greasy Meatball, welcome to the program, and where are you today? We should play that game. Where is the Greasy Meatball today? Kind of like, where's Waldo?
I'm in my office at my house today, so nothing exciting today.
Are you wearing the Waldo-esque striped shirt and hat?
No. I'm wearing a Bears zip-up hoodie.
Oh, that's almost as indistinguishable from the crowd. So, at least here in Chicago. Yeah. All right, team, with the panel all assembled, we're going to dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. You guys know the drill. This is the portion of the show we break down the wet, the wild, the woolly markets that are lighting up the old tape today. We are recording this on Monday, May 11th, for all of you playing the home game. A bit of an action, bit of some chop to the downside. Not a ton, not certainly as aggressive as perhaps some days we've seen recently with well over 1% sell-offs, but still a decent net down day on most of the major indices. S&P leading the charge, down nearly a half a percentage point, or about 9 handles to 2107. The Dow down about the same from a percentage basis, about 0.4%. And of course, the Q's down a little bit less, down about a third of a percentage point or so. Fixed cash ticking up off to the upside, getting that weekend back, getting some of that downside love back as well. North of the 13 handle again. In fact, 13.5. We're hovering around today. So some things afoot out there in the marketplace. And perhaps to start breaking it down, we'll turn to my compatriots here, starting with Mr. Greasy Meatball. While I was away in Miami, Mark, I'm sure you guys did an excellent job soldiering on the program in my absence. So well done, first off. And then what caught your eye in today's activity, sir?
Kind of a weird day. Interest rates, bonds really got slammed, and it kind of drove the whole market. And, this bond move, not a great sign for, things still, things that could still happen. I certainly would love to see things be a little less rocky on the in the bond market, because that was really what kind of threw everything for a loop, in my opinion.
Lots of loops being thrown in ye old marketplace today. Mr. Tosaw, Uncle Mike, if you will, what loops being thrown caught your eye today, sir?
Same thing. TLT, I think, is the big story today. TLT down almost $3 on the day. I think that right now, I've been long puts TLT for about a month now, or about a month and a half now, for better or for worse, so to speak. And today I took some I added some deltas to the table just as kind of like a profit-taking measure. But yeah, I think that the bonds are the big thing right now. And what's interesting is that I have been trying to stay. I wanted to stay out of the short bond gravy train, so to speak, so long as TLT was positive for the year. But about a week ago, TLT went negative. Maybe a little over a week ago, TLT went negative on the year, and so I think that I think that we're a little bit overblown right now. Just like Mark and I were talking about this a little bit on Thursday's show, but for right now, I think that just there's really the next levels of support aren't for a while in TLT, and so kind of concerned about a little bit if I were a bond bull, which I'm not. But just as I'm looking at this, I think this is going to be it's going to be a unique market, and that the bonds are the main thing that people are talking about.
Well, speaking of things that people were talking about, like I said, I just came back from the big industry conference down in Miami, and the thing that was on everybody's mind down there, as you might imagine, in the title, it does say industry, so a lot of the exchanges, the brokerage, some of the trading firms down there as well. Pretty much everyone doing a lot of hand-wringing about what's going on in the options market. Why is no one trading anymore? Some interesting data coming out of the TAB group, Andy Nybo, talking a lot down at the conference as well. They do a lot of different analysis of the options market, including what they call their liquidity matrix. They mentioned, of course, we all know already that the April number is pretty weak. By comparison, 2.8% lower than March's numbers, and substantially lower than April of 2014. Of course, they also do this liquidity matrix, like I mentioned, which is kind of interesting. They actually try to analyze spreads out there in the marketplace. And they're according to their analysis, I haven't broken into seeing exactly how they parse this, but they noticed that their spreads, according to their measures, tightened this month to 31.6 cents. That's down from an average of 34.5 cents last month, and about 36.9 at the beginning of the year. Bid offer spread size also declined, and the average trade value also declined. So pretty much every measure that you might have in the options market looking fairly negative, except for spreads tightening up a little bit. You think that might induce more customers to come back to the fold, yet we haven't really seen that much yet. I kind of put this question to a lot of people down there, as you guys might imagine, listeners, and we're actually going to stay tuned to our interviews, but also I think we're going to cut out some of these salient topics and kind of put them together so you can kind of get everyone's take in the industry on some of these hot issues like volume, like after hours trading and things like that. And we'll put those together in some separate episodes as well, so you can just sink your teeth into those if that's what interests you. But essentially, as you might imagine, listeners, I put this question to everybody you might imagine, the exchange guys, the traders, the brokers, and I got pretty much every different reason under the sun that you might imagine for why no one is trading anymore. Retail took their ball and went home. They just don't want to play anymore. There's too low volatility. There was, some people said it's too much vol. I don't really know if I agree with that. Of course, some people claiming that the institutional players aren't there anymore as a result of regulation, and that, of course, is being backed into some of the things we're seeing here, like smaller size on the bid offer, fewer players in the marketplace, hence fewer contracts going up. We certainly have seen analogous evidence like that in big institutional products like VIX and XPX, which have certainly taken a big volume hit this year. So I thought I'll give you guys, Mark and Mike, a chance to weigh in on my survey as well. Why do you think we're in such doldrums from an options volume perspective? Usually we might see this kind of stuff tapering off maybe mid the heart of summer, the dog days of summer, late July, August, when all of Europe is on vacation. Not so much in March and April. So Mike, we'll start with you. Why do you add your voice to the survey there? Why do you think options volume is pretty much in the toilet right now?
Because the stock market hasn't done anything in the last few months. I think right now it's at a point where the market's not moving. Everyone's scared. Everyone is scared to do the Iron Condor thing like they did back in 06, which I don't blame them, because if anyone was around in 06 knows how that movie ended in 08. And so I think for the most part, just we don't have a lot of movement in the market. And combine that with the fact that this is the most hated rally in the stock market history. And when I mean rally, I'm talking about the last couple of years. Pretty much everybody that I talk to thinks that we're very close to the top and that the bottom's just going to fall out at any minute, and everyone's just trying to be smart and stay out of the market. So in terms of option volume and option trading, I think that if we do actually get a continued bull market, if we break through the 2120 level on SPX, like I've been talking about for a broken record over the course of the last 20 years, it feels like, then I think we might get some players coming back into the market. But overall, in terms of why the retail people are not in it as like they were, I think it's because we've had a sideways market, and combine that with the fear of what happened, how the sideways market ended in 07, 08. And I think if you put those two together, that's kind of what is scaring people away right now.
Yeah, it's interesting, because people, you say it's the most hated rally in ages, and there certainly is some evidence to concur with that, and yet people are hating on it, but not enough to buy a put, it would seem, which is kind of odd. Don't you agree?
Totally. If you hate it so much, buy a put. I remember talking to someone back in 2009. It was in 2009. It was right when we were at the market lows, I remember. And he was just saying, S&P is going to go down to 200 or 300 points, and the whole world's going to end. And I said, well, then if that really happens, then I can present you with the opportunity of a lifetime to where the only problem you're ever going to have financially is what to do with all of your money. And you need to just buy every put in sight and short every stock in sight if you ever really believe that that's going to happen. Well, that person didn't put his money where his mouth is, but nonetheless, if people really believe that this is the most hated rally, you're right. Buy a put.
Mr. Seabass, same question for you. Why do you think we're in such dire straits, or do you maybe not think we are, from an overall volume perspective these days?
The fact that, hedging has been such a drag on portfolios for the last, you name it, causes a serious problem. In addition, it kind of feels like the 2003 period when things were really slow. And, we went from, actually it was really 2002. So after the bubble burst and the market had basically finished selling off, everybody just kind of, there was no volume. Everything slowed up. Nobody was trading. You just need some action and not pro paper. In addition, there's some market rag, but I think that, the interesting thing is I think it's easier to find a fund that uses derivatives than it used to be, yet volume is still falling off. It's what I think is that the exchanges have done such a good job marketing options to the smaller funds that they basically forgot that they need to market to the big, huge players who a few of whom have actually seriously left the market. So I don't think it's a small player problem. I think it's a big player problem. I don't think it's the retail trader. It's the large block institution that's disappearing. Lot fewer 10,000 lots than there used to be.
That's certainly true. And, you know, a lot of big players have left the space, mid-size too, UBS and others, saying we're done with these options things, not really going to make markets in them anymore. I did hear one interesting suggestion, which is kind of buried deep in the inside baseball of the options industry weeds. But if you know anything about the options market, we know we're always talking here and joking on this show about how there's a dozen exchanges, soon to be 14, two more on the near horizon. They all trade different ways. They all have different structures, maker, taker, maker, price, time, priority, customer priority, all of that stuff. But a lot of the volume these days is actually being routed into effectively types of trading styles, business styles that offer auctions. So the orders are coming in and the market makers are kind of keeping their powder dry. They're not really, hence the smaller displayed size we're seeing on the screen, and also probably smaller trade size, because they're not really putting as much up as they can. They're waiting until an auction is initiated, then they know an actual trade is happening, and then they dive in and kind of show their best markets and they trade there. So people are kind of playing a little bit of a wait and see game in the marketplace as well, particularly as you're a market maker, because they don't want to get burned anymore. They've been burned too many times. So perhaps that is factoring into some of the reduced trade size and some of the reduced displayed size, and perhaps overall reduced volume we're seeing as well. Kind of interesting stuff. Moving on really quickly, the other thing I polled everybody about in the industry, and we'll be putting this up on the network too, is something I kind of wish Alex was back on the show for this one, because I know this was near and dear to his heart, the topic of after hours trading when it comes to options. We're kind of in the teeth of earnings season, or coming right out of it, and that's when we usually get the lion's share of our requests for this type of functionality. Hey, why can't I buy calls or hedge my calls or sell to close my calls, for example, on Google or Amazon or Apple after hours, because I'm missing all these great 100 handle moves in the after hours, and the thing opens unched, and there goes all my option premium. So we hear that a lot, particularly around earnings time. So I thought I would resuscitate that discussion and put that to a lot of the different heads of the exchanges, the brokerage firms, trading firms, et cetera, and see kind of what their take is on it. And unfortunately, listeners, if you're in the camp like Alex used to be, that we're very pro after hours options trading, it seems like there may perhaps be a lot of obstacles still to overcome with that. There were very few people who were actually in support of that, except, as you might imagine, the representatives of the retail brokerage firms. They interact with the retail guy on a day-to-day basis. They hear that complaint on a day-to-day basis. They would love to see after hours options trading. And even when I put it out there, Mark and Mike, as kind of maybe a less intimidating prospect, because I got the same pushback I always did. Oh, we need market makers to staff up. They don't want to do it. We don't want to have the exchange open later. There's not enough volume. You're just going to spread volume out over those extra hours, which I think is absurd, because you have earnings, extra volume's coming in. But c'est la vie. You're going to spread the volume out around different hours, wasting time, resources, not enough volume for it. I would say, okay, forget all that. Forget the market makers. Just have a nice, simple limit order book just around some names that are having earnings, and just try that and try matching up some orders. And even then, there was very, very little uptake on that. So it doesn't seem we're getting any traction on that. Does that surprise you and or disappoint you, Uncle Mike? Are you an advocate for after hours options trading? Or are you kind of more on the fence?
I'd like to see it. I mean, personally, how I would use it, I don't really see myself using it that much. Maybe like when I'm hedging Apple or something like that, I would do something. But for the most part, I think we should have it just because of the fact that we have the earnings. We should maybe experiment with a company like Apple that gets all the trading that it does after hours and the stock side of it, and that gets all the attention to where the whole world stops to watch Apple earnings in the financial markets. So I'm definitely for it. I just like to see something happen.
Well, all right. So Mark, here's the problem, all right, with after hours and why it's not going to happen. We got too many exchanges and there's no upside. So I'm the SIBO or the ICE, and I have to do the big investment, right? I'm going to put in a ton of money, a ton of technology, a ton of this to make sure that trading is effective after hours, right? Well, then what's going to happen is you get the Miami exchanges and the NASDAQs of the world that are basically flip their maker-taker model on, where basically all they do is have guys that are basically running joiner scripts 10 up to try and poach paper. So basically the exchanges that actually have to put the investment in get no upside, and to the benefit of the exchanges that would put minimal investment in. It's very cheap to start an exchange in the current market, but I don't think it's cheap to launch new hours in the current market unless, like I said, some of the exchanges jump along with it. Jump along. You actually need to clear away some of these exchanges.
Well, I don't think anyone's going to argue against that. 14 is getting to the point of redonkulous, to use the technical term, out there.
We need 5, maybe 4.
Yeah, I think after we hit 4 is when I started to hear the question of how many do we need, and then we got to 5, and then 13, 14, you're getting beyond de minimis.
Fair, the ice was far more additive than when the ice came on. It added more to culture than the Pecos and Philex ever have. So, the ice was the 5th exchange, and the reason why people started asking that is because they didn't want the electronic exchange cornering in. But once the ice really forced everybody to go electronic, then the question is, how many exchanges do you need, right? And how many models, and how much conflict of interest can we create with all of these different models is my question. And
I take that back. It wasn't around 4. It was 2004, but it was number 6, I believe, which was box. That's when I started hearing. So, wait a minute.
At least the NASDAQ brought a new idea to the table. Even if it's a bad idea, they did bring an idea to the table. Now it's just a bunch of junk exchanges trying to poach a little bit of paper and wet their own beak. There's nothing additive, and until we incentivize exchanges to actually be exchanges, you will never see after-hours trading. So, basically, until they change payment for order flow, you're not going to see any after-hours exchanges.
One guy did make an interesting point. That's Steve Crutchfield, who runs a lot of options for NYSE, now ICE. He mentioned also the possibility of having one of those after-hours limit books. He'd say he made a good point. He said you'd see a lot of weird stuff going up that couldn't be put up during the day because it was outside the rules of what they could allow to put up. People would be facilitating things all day long in those after-hour limit books in some of these weird names that they were allowing. So that was one of the few points I thought had any actual credence to it as to why.
And that does. I didn't even think about that.
That's insane. That was a great point. A lot of the other one is your typical exchange hemming and hawing. They don't want to do it. But that one has actually a good point.
Brokers doing that kind of crap.
And they would. They would force everything.
Yeah, you'd need some new regulations.
Yeah, and if you're one of those people out there who gets up in arms about things like Flash Boys, stuff like that, and all the things people get away with in the marketplace, imagine what they could do in a less regulated after-hours environment. That may give you some pause about cheering for an after-hour session. Like I said, good stuff here. We got a lot more of that coming down the network, so stay tuned for that. Meanwhile, we're going to keep on rolling right on into our next segment. It's time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Everybody, welcome to the Odd Block. You guys know the drill. This is the portion of the show where we get a little dirty. We get into the shadier side of the options business and see what's cooking on the other side of the tracks. Going to kick things off with a name you may have heard, may have traded once or twice. I believe it's pronounced SPY. This is, of course, a SPY. That is indeed the S&P ETF, of course. And I won't even bother giving you the ticker. If you don't know that, then you're listening to the wrong show. And, of course, this is the name that does a wee bit of paper. We're starting things off with a bang here, listeners. ADV on SPY these days, about 2.1 million contracts. It does lighten it up. Even though everything else is off substantially, SPY still doing a decent off a bit as well, but still just ridiculous amount of paper going up in SPY. Only about 1.6 going up today, 1.6 million. So it wasn't overall volume that caught our eye as much as it was a few trades in particular. Both of them seeming linked. Seems like we got perhaps someone thinking the better of a strangle and deciding to take it off. In particular, looking at the June 194 on the put side, going up when we started profiling these 3,500 times. And the June 219 calls on the upside, those again going up, both of them going up 3,500 times in the beginning. As the day went on, a lot more volume, over 10x going up on these strikes to the tune of over 37,000 going up on both of these strikes. Just tons tons of size. As you might expect with a name like SPY, there's some open interest on all of these strikes, but a decent amount on these strikes as well, of course. 219 strike has about 76,000 contracts and about 55,000, on the 194 puts. So fair chance it may be a friend of ours, perhaps buying back some short strangles, sold them last week, applied vol a wee bit higher last week, taking them back off on this strangle, perhaps thinking, hey, the run to the downside from a vol perspective is off. Certainly seeing some of that perhaps today, and so deciding discretion is the better part of valor and taking off their short strangles. Mr. Sebas, we shall start with you. What's your take on this? You think our friend is closing, or you think he's perhaps diving in feet first?
Oh, I think typically when you see vol go from 17 to 14 and the open interest matches, you're going to see it's going to be a closing trade, and I think that's what we're looking at here. I'm almost certain that was a closing trade.
Are you a fan of closing out some short strangles right here, right now?
Yeah, when once you've made a bunch of money, take your money off the table. All right?
Kind of hard to go broke that way.
Your money.
Yes. Sell high vol, buy low vol. It kind of works. I don't know. We go to all these elaborate strategies on this show. You guys spend all your time teaching these people. But, just sell high vol, buy low vol. It's pretty simple at the end of the day. All right, sir, as we move on to our next name here on the old program, Cleopatra, not a fan of this one. This is ASPS, Altisource Portfolio Solutions. A few history majors out there laughing at that one. Everyone else looking at their iPhone or Android phone in surprise and shock and saying, what is he talking about? Moving on, ticker symbol, like I said, ASPS, ASPS, closing today 30.5 or so, up about 55 cents on the day. Got some more action on the put side out here. Not a strangle or closing this time, more on looks like just a straight up roll. In particular, it was the July OC 15 put spread going up, and we started profiling it about 1,700 times, a total of about 2,000, so a few hundred more filtering in afterwards. Exactly 2,000 going up on this July 15 strike, and lo and behold, the open interest 2018. So when it lines up that nicely, it tends to be what it appears to be, at least usually. In this case, it looks like it appears to be someone taking his downside puts. These are pretty far downside. This is a 50% drop in the underlying he's hedging against. But he still wants that protection, and he wants it at that 15 strike. He didn't take the opportunity to roll out and up, maybe to the 20 strike or the 22.5. No, he said, I still want to draw that line at that 15 strike, and did it 2,000 times again. So we'll see. He did it net for 45 cents, paper buying listeners. So interesting choice that he didn't do an up and out market. This was you constructing this portfolio. Would you maybe have taken the opportunity to get it a little bit tighter to the at the money?
Probably, but you never know. Maybe he's got some weird position on or something like that. I thought it was really a bit of an odd trade myself, but it's maybe he's trying, longer term trades can sometimes be a cheaper trade than doing them shorter term. Maybe it's that. I don't know. It's just kind of a weird one.
Hence the odd block. Yeah, that really kind of struck me as odd. He must have some weird stricture in this trade that prevents him from moving away from that strike, because I think any sane person, granted, you're going to pay a little more for it, but at this point, what are you hedging? 50% down move in the underlying? Is that really is that protection of much value to you at this point? Probably not. So this is a bit of an odd one. Listeners, hey, write in. Tell us why you wouldn't adjust your strike. I have to feel a lot of you probably would. But hey, maybe some of you have some interesting takes out there on why you want to keep that 50% catastrophe put in place. Let's move on to our final name here. This is one we talked about before. It's been a while. This is Iron Mountain Inc., ticker symbol IRM. You guys know these guys. You've probably seen the trucks. We see them all around Chicago all the time. They come around, they shred your stuff. A lot of data security and management stuff, primarily with hard copies. Trading today, or I should say closing today, $35.67, up about a quarter or so on the day. It's the name that does not a heck of a lot of paper, about 600 contracts. Doing a heck of a lot of paper today, over 16,000 contracts. Pretty much all of that, 16,010 of the total 16,370 coming in one very, very sizable vertical here. In particular, it was a little bit longer term. The Jan 2016, I should say, 37.5, 42.5 call spread going up for $1. Paper buy-in, and they just did it straight out 8,000 times. No playing around. They did 2 blocks going up on the ARCA mark spread. If you know a lot about spreads, they tend to go up on these exchanges like ARCA still when they can facilitate some of these things, and they still do a lot of business on that floor as a result. Listen to my conversation with Steve from NYSE ICE to hear more about that coming out of OIC. But yeah, 8,000 times paper buy-in for $1, so buying a $5 spread for $1. Interesting. And like I said, no open interest on these strikes, so pretty much all opening here. This is about a little over under two handles, I should say, away from at the money. But he's got some time for this to run. So a $5 out of the money call spread, about 2 handles out of the money from here, so actually about $7 out of the money. What's your take on our friend here, Mr. Sebas, loading up on some farther out upside here in Iron Mountain?
Apparently, the document storage and shredding is going to be pretty good over the next couple of months.
Yeah, who knew?
Makes sense to me. I mean, you know, you're required to store so much because of regulations. Maybe it's something like that. Maybe this is a lot of people betting that you know, we're going to be forced to store more and more hard copy stuff, especially with the maybe all the hacking that's going on. Maybe hard copies are going to be more important than they used to be.
Maybe this is a roundabout bearish bet on the market. He's betting the market's going to tank, and all the brokers are going to be just shredding their documents left and right. It's going to be a boom market for Iron Mountain. So he's loading up on some upside here. Either way, an interesting one. Yeah, you don't think immediately jumping to mind, hey, tons of upside here in the paper shredding and record storage business. Apparently, our friend here thinking he knows something we do not. I'll pay attention to this one. This one's a little bit longer term. We can file this in the to be watched category. All right, and that's going to do it for the old Odd Block segment. And now, because it's been a while, it's time to check back in with Uncle Mike for some strategery as it's time for the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the Strategy Block.
All right, listeners, you guys know the drill. This is the portion of the show where Uncle Mike grabs his smoking jacket, lights a nice roaring fire, though perhaps keeps it a little bit lower because it is getting warmer again, grabs that bubble pipe and those stone tablets, and sits down, brandy snifter in hand, to dispense some options wit and or wisdom. Uncle Mike, it's been a while since we've had this segment, so what are you going to give us? Wit, wisdom, or perhaps, dare I ask, both?
I'm going to do my best to give it a little bit of both.
All right, I'm excited.
Not much of a brandy man, but nonetheless, appreciate the intro. Just in looking at things, what I want to go through today is a trade that I made today, actually. I've been talking on the show and how 2120 is kind of a key number for me with the SPX. And I think that once we get through it and can close above it, I can see us really having a very nice bull market. But unfortunately, we keep knocking on the door of 2120 or about that area, and we just keep coming down. We've been playing this game ever since mid-February, and that markets went down a little bit at the beginning of the year. Kind of were in a channeling pattern. Then we got above the 2060 level, and then we had a nice little rally right up to the 2120 level or thereabouts, and then nothing after that. Comes back down. And it's like we keep flirting with this level, or we have since mid-February, and we just can't seem to break through. Now, what I've been doing a lot this year is I've been either selling short calls or doing calendar spreads. And so today, what I decided to do was sell a calendar spread. I didn't feel that I wanted to take on the risk of capping upside in this market, even though we still have not gotten through the major number that I have in terms of looking at it. So a couple of things with which I looked at today. First thing, just to kind of set the stage for this, the position with which I'm speaking of is my long September 209 call on SPY. And so I've rolled that call out a few times since the last time I've really gone through this in detail, but that's the current long call that I'm in right now. So what I just got out of a few days ago was a 213 short call on SPY for the month of May. We took some profit on that. And so the philosophy behind that was that if we are going to touch my short call option, we're going to have to make new all-time highs to do it. We didn't make new all-time highs. We came down a little bit in the marketplace, so I got out of it and made a little bit of money on that specific call. Once again, it's not a huge thing, but it's just designed to hedge time decay risk. That's the entire reason why I do any of this, is to finance this. The other position with which I'm in that you could use as a base position is long SPY, and then also long a September 199 put. So we could also use that position. I'm trying to finance the 199 put as well as the 209 call. Now, today, what I ended up going with was a June week 1 208 put long and a May week 4 208 put short. So just a 208 put calendar spread. And the concept behind it is that I didn't want to take off too many deltas. I did not want to I didn't want to limit upside in this market, just because I think that if we do break through this 2120 level in SPX, I think it's going to go up pretty quickly afterwards. We just have to break through it for the time being, which we have not. So by doing this, I took off a total of, for every long contract that I'm in, or 100 shares with long put that I'm in, took off maybe about 7 or 8 deltas approximately today. Now what that does is a couple of things. The first thing that it does is if we do have a little bit of a pullback, we'll be able to make something off of that put calendar spread, which that's a good thing. Second thing that it does is it does not limit upside. So if we do all of a sudden just go off to the races and we find the cure for cancer and Europe comes out and says, April Fools, everybody, there's no debt issues whatsoever, and all the wonderful things happen tomorrow and the S&P 500 goes up to 4,000, hey, that's great. I'm a part of it. Now, getting back to reality, let's say that we do have a little bit of a pullback, or we just kind of are just knocking on the door of this 212 level again, or 213 level on SPY. We have a little bit of theta in place, not a lot, but at least a little bit, to where we have some type of a downside hedge for a very small amount of space, as well as getting a little bit of time decay financed. So by doing this, in comparison to just selling another 213 short call or a 214 or 215 short call, this was the choice with which I went with this time around, just because of the fact that I did not want to limit upside on this trade, and I wanted to just have a little bit of deltas taken off the table and adding a little bit of time decay to the trade itself. And that is the strategy block for today.
All right, that was the wisdom. Now I'm still waiting for the wit. Give us a joke or something. Don't leave us hanging.
Let's see. Whoa. Did you hear about the pirate that got its ears pierced?
I did not.
You know what he paid? A buccaneer.
Not bad.
Oh, that's just terrible.
Not bad. You've been hanging out with some 5 and 6 year olds. I can see that. I have similar jokes in my repertoire, sir, so I can commiserate with you. Well
I got plenty. I got some. Just it's not a dirty joke, so Sebastian must not like it. But
Oh yeah.
All right. On that note, we shall keep on rolling. I've got a few minutes, so I'll let you guys squeeze in a little bit here, too. It's time to open up the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
All right, everybody. Like the man said, this is the portion of the show where you guys get to take the reins, let your questions, comments fly. You know how to reach us at the website, theoptionsinsider.com. Questions, comments, website feedback form, all that good stuff right there. Via email, questions@theoptionsinsider.com. Social media, twitter.com/options, facebook.com/theoptionsinsider, and from StockTwits. We are Options Insider on StockTwits. For whatever reason, we don't get a lot of questions via Facebook. I don't know why it is, but a lot of our listeners like to use other means. They use Twitter, they use email, they use the website a lot. For whatever reason, they don't like Facebook. So whenever they pop up on Facebook, I like to service them every now and then. If you guys are using Facebook, let us know. Shoot us some questions over there. People love to read our stuff. They just don't ask questions on Facebook. I don't know why. Maybe our listeners are shy on Facebook anyway. But this one coming in from Nicolas B. I'll leave out his last name here. He wrote a very long question, and I couldn't really read any of it. And I could tell he probably was using some sort of mobile platform because it was all autocorrected to death. He then wrote in and said, damn autocorrect. Pardon my stupid keyboard. Let me rewrite that for you. So he wrote, first of all, many thanks for... He still writes a road, as in Rhode Island. I'm not sure what a road podcast. I'm going to assume by road he meant fantastic, awesome, great podcast you guys put online. So you're welcome for that, Nicholas. Very educational. My question to you guys is, what is your personal favorite trading platform and why? What platform would you suggest to someone starting in this business? Well, those are actually two interesting and kind of two different questions. I think the platform I would recommend to a newcomer is different than my overall favorite platform. Like a lot of people, for example, love IB. They really love it. They aim at professional client. The execution and things like that are good, but I would never recommend IB in a million years for a newcomer to options. It's just a daunting platform. He says new to the business. I don't know if he means professional or just a high-end trader. Either way, I'm gonna structure it like the latter. But it's interesting conversation, I know, and it's one of the good things of the situation we're in on the show here, where we can discuss this kind of stuff right now. And I tend to vacillate for a few that I think are reasonably user-friendly. I use a lot of OX, obviously, because we worked with them on the show for quite a long time. I also use TOS and the TD platform quite a bit as well. Those are probably the two I go back and forth with the most. They both have different strengths. I think the OX clearly has the idea generation one down. They've really got that down with the idea hub and a lot of other cool tools on there. Some of the execution stuff in terms of how easy it is to enter spreads, and particularly on the spread side, TOS has that great spread book that they've had for a long time. So that one I think is very, very clear. But even still, I kind of wonder if some of those platforms they've been iterated on so well, they clearly cater to our audience, the high-end active guy who wants all those bells and whistles. I kind of wonder if I was looking at them for the first time as a newcomer to the space, if it might be a little bit overwhelming. I think the TOS display, it shows a lot of information, but it could be overwhelming. Same thing with OX. So maybe in that scenario, it might even be better to go and just go to a more straightforward type platform. I was talking to the Options House guys recently. I haven't had a chance to kick the tires on their new platform to see if that would be it's more of a straightforward option, might be a little bit easier. I do know the Trade King platform. I've used it a few times. That could be perhaps, if intimidation is a problem for you, that might be a more clear-cut way for you to go. But if you don't mind biting off a lot of the bells and whistles and all the things we've talked about on this show myriad times in terms of tools and things, I don't think you can go wrong with either of those two, the OX or the TOS. Maybe Uncle Mike, will start with you. What is your platform of choice these days, or do you kind of like me kind of hop around depending on where the account is and what your need is?
Yeah, I would say that. When I started off in the business, I was working for Options Express. Options Express was in their heyday at the time. As in the 2005, 2006 era, that was seemed to be the only thing that retail traders were even messing with. And it was it seemed like this advanced, fun thing that that really felt like Options Express was changing the world with what they were doing. And there was this one guy that wore a beret and had long hair that was always in the corner of all the trade shows that would always kind of laugh and come up and just smile and say, hey, I'm just trying to get the low-hanging fruit of you big guys at Options Express. That's all I'm trying to do. And needless to say, we all know him. It's Tom Sosnoff. And we know the story with Thinkorswim. It became very big, and it eventually took over everything in the retail space. Not everything, but a very big portion of the retail space. And I can remember working at Options Express and watching us lose a lot of business to Thinkorswim, and just hearing clients left and right when I'm going on the road saying, you guys really need to look at this Thinkorswim platform and learn from it. And so with that being said, I think that for a beginner, Options Express is a very user-friendly platform. I think it would be very good for a lot of people. But once you get a little bit more advanced at the next level, I'm definitely a fan of the Thinkorswim platform for the retail trader. What I use personally is actually something called ThinkPipes. And ThinkPipes is the institutional version of Thinkorswim, meaning that if I have multiple accounts, let's say I have 2 accounts that I'm trading at the same time, Joe Blow in Iowa and John Doe in Georgia, and they're both in the same strategy, I have the ability to trade their accounts at the same time through ThinkPipes. And they would have a TD Ameritrade account, but the ThinkPipes platform would execute the trade into both Joe Blow and John Doe's account at the same time. So long story short, I think Options Express is a good beginner platform. I think Thinkorswim is a little bit more advanced for a retail trader. I definitely like the Thinkorswim platform. In terms of interactive brokers, the one reason that if I were a retail trader and I would use Thinkorswim is if I was trying to do something highly levered using portfolio margin, because their margin rates are dirt cheap. So in comparison to a lot of the other retail platforms, so let's say that you had 200 grand and you wanted to buy $600,000 worth of stock, let's say, and hedge it in certain ways, and you have a portfolio margin based plan. If you're looking to do something like that, the interest rate at Interactive Brokers is nice. However, the platform and the customer service do lead something to be desired. Commissions are great, interest rates are nice on margin, but the other things, you do have to be prepared to deal with the less than the best customer service. So nonetheless, that is my take on a lot of the major brokers.
And you bring up a good point, I think, with the think pipes. A lot of that stuff is kind of moving that way, which is, systems, particularly for the high end of the active retail space and the institutional space, just saying, forget your front end. I want the data. I want to act on it myself, and just using the APIs, which is kind of what think pipes is really, to just access that in a lot of different ways. We're actually seeing some startups pivoting that way and saying, forget the front end. That's where all the expense and the hassle is. We'll just push all the stuff out to them via APIs and let you guys do with it what you want. And who knows, maybe that's the future of brokerage, is to build your own platform. That said, Mr. Sebas, what's your platform of choice these days, or do you have multiple favorites?
I'll be honest. If you need analytics and you're trading any of the professional products, Thinkorswim is almost useless, because for some reason they have an inability to calculate a forward value. And so if you are interested in trading VIX, interested in trading SPX, the Russell 2000, really, a lot of the major brokers are terrible because they can't calculate a forward value. I've never understood it. I don't get it. Personally, I'm a fan of LiveVol. I do have a small account at Thinkorswim. There's some things I like over there. For their risk charts are good, and they've got some decent back trading. OX is fine, nothing special. Trade Monster / Option House is fine, inexpensive. There are some really cheap options floating around out there. The New Player Trader is inexpensive. So really, I think you go one of two camps. Either go like a LiveVol route, where LiveVol IB route, where you're basically a professional trader. You go to the Think Pipes approach, which is the professional money manager, or you go kind of the ultra retail and just go for the inexpensive approach. 90% of retail traders, all those bells and whistles on Thinkorswim are too much. If you're a stock trader, there are better places to be than Thinkorswim. And so that's kind of my thought. And it's really irresponsible that they can't. I just never understood how you can't figure out how to calculate a forward value.
One of your pet peeves, but I know you've been extolling the virtues of the LiveVol X for quite a while. That certainly would cater to the very ultra high end of our audience. They like to attract a lot of market makers to that platform. But I'm not sure what category Nicolas is in, but if he's in that high end of the space, then maybe LiveVol X might be worth kicking the tires on. Otherwise, if you're a little bit more basic on the spectrum, some of the other ones, I often kind of wonder if some of these brokers, I know they hate to do it because they hate to strip out functionality, they spend all this money developing all these cool bells and whistles, but maybe for a guy like Nicolas, if he's just starting out, maybe you get to the brokerage platform and it asks you a question, rate your skill level. Are you a beginner? Are you new? And depending on how you answer that, it may scale back some of the UI assault that a lot of these platforms can do to you. If you're coming in, you kind of just want to buy a call, and here you are, all this crazy stuff is hitting you on toss, is the sizzle on this thing, and OX, it's got, the idea hub and this and that, and bam and boom, and the dragon, and it's like, whoa, it's kind of this information overload. So I know they don't want to do that because they like to lead with their platform, spend a lot of money developing it, and certainly they are robust, but I sometimes wonder if perhaps we're almost scaring away some of the new entrants to the space with all this cool stuff that we love, but maybe a little bit overwhelming for them. Either way, great question. Nicolas B., you guys out there on Facebook, we love to hear from you too. Don't let the emailers and the website guys and the tweets, the Twitterers, legions of those, overwhelm you guys. Stake your claim back on Facebook. Meanwhile, it's time for us to keep on rolling. It's time to roll right on into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, welcome to Around the Block. This is indeed the portion of the show we tell you what we're watching for the rest of this week. And Uncle Mike, I know you have your eyes, your ears, your nose, every sense fixated on this one pivotal event that is, of course, Cisco earnings coming up this Wednesday. I'm sure that's pretty much, you can't think of anything else.
You know, this is kind of like the pinky and the brain block for me right now in terms of what we're watching. What are we going to do tonight, brain? Same thing we do every night, pinky, try and take over the world. So what I'm watching is the same thing that I've been watching for a while, and that's 2120 on the SPX. And I would love to see us cross it, but until then, I'm just watching it. And yes, I did purposely ignore the Cisco comment.
Yes, I'm sure. And Mr. Sebastian, in addition to typing furiously and, of course, watching reruns of Pinky and the Brain, as everyone should do. What are you watching for the rest of this week, sir?
A funny show.
That was a great show.
I loved that show.
Animaniacs. That just all across the board. Good stuff.
There's not enough kids' cartoons about taking over the world these days, in my opinion.
Yeah, I concur. They need more of those. I am watching interest rates. I think as interest rates go, so goes the market, and that's going to be the key. All right, and that's where everything's going to come.
And just to reiterate, you believe the Fed will act and increase rates by this June meeting, correct? And you've wagered heavily on a bunch of stakes on it.
I think it's going to happen, but I think people are really nervous, and I've never seen people get so puffed up about what amounts to almost nothing. And but that's where we are.
Certainly seems to be a very dim prospect that they can move in June. Anything's possible, of course. We've seen crazier things. We've seen the entire government downgraded and all sorts of other fun stuff. So nothing is impossible, but still certainly seems unlikely they would move by that fast. But we'll see, as time will tell. As meanwhile, of course, that's all the time we have for the Around the Block segments. Also all the time we have for this episode of the Option Block. But before we go, as always, let's check back in one more time with my compatriots here on the old All-Star panel. See what they have cooking up that may interest you. Starting off with you, Uncle Mike. How did the big event go last week? I'm sorry I missed it. I was elsewhere in Miami. And what else is cooking in the land of RCM?
Event went real good. Had a good turnout. And then in terms of what else we got cooking, I'm just going to open this up again as the floodgates have the floodgates have calmed slightly since the last time I've done this, so let's get them going again. If you have $500 a month and you're looking to invest with a financial advisor and you feel that that's not enough money to invest, call me. It is enough money to invest. Would love to work with you in any way, shape, or form. Feel free to give me a call at 312-212-3531 or send me an email at mtosaw@rcmfs.com.
There you go, listeners. Hit him up. See what he can do for you. And Mr. Greasy Meatball, what's cooking in the land? Oh, the pit.
We got a webinar coming up on the 20th. Optionpit.com/creating income. Creating income with option spreads. It's going to be a fun, full hour of education and absolutely worth your time. I'm also speaking at SIBO tomorrow at 3:30. That's a Tuesday, the 12th, if this gets out by then. You can register at cboe.com. Either way, that's going to be using volatility to trade for direction. Both are going to be great webinars, both worth attending. So hope to see you there.
So creating income, that's pretty much just buying straddles all the time. Is that it? Is that the trick?
Yeah. No, it's going to be mostly about selling and risk management and sizing.
And buying straddles.
And buying as many straddles as possible.
Create that income through buying. Well done, sir. Surf on over to optionpit.com to learn more. And on behalf of the Greasy Meatball and Uncle Mike, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. Remember, stay tuned to the network for all that goodness coming out of the Options Industry Conference. Should be hitting your podcast player any day now. And we'll see you next time right here on the Option Block.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.